My name is Glen Matsumoto. I'm partner and head of infrastructure for Actis. And Actis is an emerging market investment manager headquartered out of London, but located with offices throughout the emerging markets. In terms of the macro trends for emerging markets, it is just phenomenal what's been going on. As an example, the power sector is just booming. Renewables have been a big story throughout the world. But what we have seen is because of subsidies in developed markets for solar power and for wind, over the last decade, solar power has decreased in cost, a levelized cost of production by 90%, 20% in the last calendar year alone. And so what we have over the next, call it 30 years, is 80% of new generation in the world is going to be renewable energy. And a vast majority of that is going to take place and be installed in emerging markets. And power, as economists have seen over the years, is a key aspect of driving economic growth. And so it's a big trend that is going to continue throughout our lifetimes and beyond. Yeah, in terms of the investment thesis in growth market infrastructure, it is about the growth that is occurring and the growth opportunity. There have been, as we know, in the US, Europe, in the developed markets, quite a bit of development of infrastructure over the last 100 years or so. What we haven't seen has been emerging markets really catch up to this. And we're seeing, because of the lower cost of energy, which is because of the subsidies that have occurred for solar and renewable, because of that, the cost of deploying power in emerging markets has just plummeted. And as a result, what we have is many of these markets have very strong wind and very strong irradiation for solar power. And as a result, what we are going to see is investment, both public sector, but a lot of private sector investment going into emerging markets for the power sector, and then beyond in other types of infrastructure, such as water and sanitation, digital infrastructure, and what have you. So again, this is a trend that is going to continue, and these countries cannot do this by themselves. They do not have the budgets. What they have done over the last 30 years, in some instances, these countries have recognized what foreign investors need in terms of protections, risk mitigation, and what have you. And they have been steadily putting those in place, not always on a straight line, but they have been doing trial and error, learning from other countries, and they've been putting those in place, those structures in place, legal, regulatory, contractual structures, in order to accommodate private sector investment from foreign sources. And so with those combinations, we're going to see a huge investment opportunity for private sector investment in emerging markets. In any type of investment, one of the key things that needs to happen is the investors that are finding opportunities, developing opportunities, needs to know these markets, needs to be on top of these markets. I think at various times, infrastructure is a prime example. You may find, because of rising stock markets, you see the opportunity to invest, and if you will, the rising tide rises all boats, if you will. And I think, as we've seen over the last few days with kind of more volatility in the public stock market, the key thing here is going to be, how do you make sure that you go into these types of investments and you're thinking to be steady, reliable, and to be able to invest long-term, because that's what infrastructure is about, long-term investment. How do you find those opportunities? And the way you find those opportunities is with investors, with investment managers that have the presence on the ground, that know these markets, that know how the regulations work, that have been investing in these markets for many, many years, and have made mistakes as well as have successes, because you learn from those mistakes. And so that is a key aspect here. And for better, for worse, the infrastructure market from its inception has primarily been a developed market investment thesis, if you will. And primarily because investors have seen their infrastructure allocation as being the low risk part of their portfolio, not their high risk, not going for those home runs. They've been seeing infrastructure as their low risk. The mentality for thinking about emerging markets for many years has been, geez, it's emerging markets that must be high risk. And so what we have seen over the years is, again, because of the development of the legal, regulatory, and contractual structures, the risk profile has declined. And when you have investment managers that have been in these markets, that have been investing through the cycles, that have participated as these structures have improved, that is the best way to get the kind of steady, reliable returns in a volatile global economy. In terms of investing in emerging markets, we have the growth, and we have now installed capacity. And both of those areas have opportunity for investment, for private sector investment. And the question is, how do you balance that? And in my view, how you balance that is you have to focus on certain areas. So if you are a growth investor and you're looking for getting that capital gain, you're looking for a shorter term, more of a private equity style return, then you invest in earlier stage. You invest in the construction of infrastructure, power generation assets, solar farms, wind farms, and what have you. You invest earlier, and you invest in investment managers that know how to manage that and manage the permitting, manage the construction aspect, getting things done on time and on budget. And then you look to scale. Look for those strategies where now you're able to build and scale and take advantage of that and get that capital gain. That is a growth way of investing in these markets. And because of all the needed capacity, you're going to see that opportunity. However, what we have seen, because this phenomena of additional investment has gone on in emerging markets now for, some instances 20, 30 years, you have now installed capacity for infrastructure that exists in these markets. You have installed power generation assets, power utilities, transmission lines that have been funded by private sector investment. So these don't have construction risks. They don't have permitting risks. They have long-term contracts. They have steady, reliable cash flows, if you will, the more classic core infrastructure style investment. You can invest in this sector, in these sectors of established operating assets, and hold these assets for a much longer period of time and cultivate those assets in those investments for yield, for cash flow yield. So classic core investment. At this point, we believe that the opportunity for return for that type of core infrastructure provides investors an additional return opportunity for a similar risk profile. So I think there's growth opportunities, capital gain, and there is long-term hold, yield-oriented investment strategies out there.